Welcome to Iron Financial, the explainer, where we cut through market weakness, inspect the underlying metrics, and help you forge a stronger, more resilient portfolio. I'm your lead analyst, and today we are looking at a company that is essentially the structural steel of the entire global semiconductor industry. We are, of course, talking about Texas Instruments, ticker symbol TXN.
And I'm your market skeptic. Now, you might be totally ready to rubber stamp this company's financial blueprint based on the headlines, but I'm here to stress test the foundation. Today, we're not just unpacking Texas Instruments' latest Q2 earnings report, we are analyzing it alongside a massive, multi-billion-dollar M&A announcement that completely reshapes their capital structure.
Exactly right. We're talking about incredibly aggressive moves that require some serious heavy lifting to understand. Texas Instruments is pouring concrete for the next decade of their business right now, and we're going to inspect every single inch of it. If you want to keep building your market edge and forging a stronger portfolio, make sure you hit that subscribe button. All right, let's grab our hard hats, dive into this, and start the inspection. Lead Analyst, Section 1. The Foundation Shakes. Let's look at this sudden growth and the strategic acquisitions. So the foundation shakes, but in this specific case, it is shaking from the sheer weight of a dual-threat Q2 drop. We aren't just looking at your standard run-of-the-mill quarterly update here. We're looking at a massive acceleration in sudden growth, paired literally on the exact same day with an aggressive strategic acquisition. The top-line numbers are absolutely ironclad. The lead headline we have to hammer home is a massive 23% year-over-year revenue jump, landing at a cool $5.5 billion. And if you're looking at it sequentially, that's up 13% just from Q1. This isn't just isolated growth in one lucky sector. This is broad-based strength forging ahead across their industrial, automotive, and data center markets.
Hold on, let's pump the brakes just a bit. It's the exact kind of double announcement that makes institutional money on Wall Street pause. Usually, right, you get steady structural growth, or you get a massive acquisition that kind of distracts from the core operations. Getting both at the exact same time means management is either incredibly confident in their structural integrity or, and this is what we have to watch out for, they are trying to mask cyclical vulnerabilities with shiny new toys. I hear those percentages, 23% year-over-year growth sounds like a reinforced concrete pillar of demand. But we have to ask the hard question, is this real, sustainable demand recovery across automotive and industrial? Or is this simply customer inventory rebuilding? We all know semiconductor cycles are vicious. If their customers let inventories drop to historic lows and are now just restocking the shelves, this 23% growth is just cycle hype. It's not a permanent new baseline, it's just a temporary spike.
Well, we are absolutely going to get to the sustainability of that growth, but we have to immediately pivot to the absolute wrecking ball of an announcement that accompanied those earnings. Texas Instruments is executing a $231 per share all-cash takeover of Silicon Labs. This establishes massive, undeniable financial stakes, creating a total enterprise value transaction of approximately $7.5 billion.
$7.5 billion, and I want to emphasize this for everyone listening, in all cash. That is a massive capital allocation decision. You don't just drop $7.5 billion in cash without fundamentally altering the structural integrity of your balance sheet. They expect this deal to close in the first half of 2027, subject to the usual regulatory approvals, but we really need to drill down into how they are paying for this and what it means for the shareholders. TXN shareholders are used to getting a very specific, very reliable cut of the profits, and a cash deal this size changes the math entirely.
Section 2. Financial Heavy Lifting. We are inspecting the Q2 2026 core metrics to see exactly how much weight this company can carry. To understand if Texas Instruments can actually support a $7.5 billion cash deal, we need to transition to the granular financial mechanics. We are preparing to inspect the underlying foundation of TI's profitability for Q2. This is the financial heavy lifting that determines if this company is a high-yield fortress or a house of cards waiting to collapse. Just look at the sheer scale of this aggressive margin expansion. Gross profit margin expanded by 340 basis points quarter over quarter. For those tracking the raw data, that means they hit a rock-solid 61% margin, delivering $3.4 billion in pure gross profit. And look at the operating profit. It jumped to $2.31 billion. That is a 48% year-over-year increase, bringing their operating margins up to 42%. That is pure, unadulterated operational leverage at work. As they increase factory loadings, meaning they are running more wafers through their existing factories, their per-unit manufacturing costs drop significantly, and all that extra revenue drops straight to the bottom line. Market skeptic. Okay, I won't deny that a 42% operating margin is exactly the kind of metric that builds a fortress. It's incredibly impressive. But we have to recognize that they are still carrying the massive fixed costs associated with their planned capacity expansions. Yes, the gross profit benefited heavily from factory loadings this quarter. They flipped the switch, ran the factories hot, and the margins expanded. But what happens when the semiconductor cycle turns? What happens when demand softens and those factories aren't running at full tilt? That massive operating leverage can swing both ways. And in a downturn, idle factory capacity turns into a heavy, heavy liability, dragging down the entire income statement. That's a completely fair point regarding cyclical risk, but to counter that, you have to marvel at their ironclad cash engine. Quarterly free cash flow for Q2 alone exploded. It was up 271% year over year to $2.74 billion in a single quarter. This absolute gusher of cash drove the trailing 12-month figure to a staggering $6.5 billion. Just to put that into perspective, that is up from just $1.8 billion in the exact same year-ago period. Ultimately, this represents 33.6% of their top-line revenue turning directly into free cash flow. They are essentially printing cash at this point in the cycle.
Market Skeptic. A jump from $1.8 billion to $6.5 billion in trailing 12-month free cash flow is undeniably impressive. You look at that metric and you think this company is invincible. But before we declare this the ultimate self-sustaining cash engine, we need to inspect where that cash is actually coming from, because it's not all just coming from organically selling chips to automakers and data centers. There is a massive structural support beam holding up these cash flow numbers, and it comes straight from Washington, D.C.
You're talking about the U.S. government subsidies, and you're absolutely right to point them out. The structural support from the CHIPS Act is significant, and it is deeply embedded in these financials. Texas Instruments realized $1.6 billion in total trailing 12-month CHIPS Act incentives. If we isolate just this recent quarter, Q2 2026, they received $549 million in direct incentives, plus another $301 million that was used to reduce income taxes payable via the Investment Tax Credit, or ITC.
Exactly my point. When you strip out that $1.6 billion in CHIPS Act money, that $6.5 billion free cash flow number suddenly drops back down to $4.9 billion. Now, don't get me wrong, $4.9 billion is still a very solid foundation for any business. But let's be honest here. The government is artificially padding the free cash flow balance sheet. Yes, these incentives absolutely lower the upfront capital costs and mitigate the risks for factory construction right here in the U.S., but they severely distort the true organic cash generation capability of the business in the short term. It makes the engine look a lot more powerful than it actually is on its own.
Which leads me directly to this absolutely crucial question. Texas Instruments reported a net income of $2.0 billion and an earnings per share, or EPS, of $2.14, handily beating estimates. Wall Street cheered. But how much of that $2.14 EPS beat was propped up by discrete tax benefits? If you read the fine print, the filing clearly states that the EPS included a 5-cent benefit that wasn't in their original guidance. I'm stress testing the foundation here because that's my job. Between government cash injections, discrete one-off tax benefits, and potential customer inventory rebuilding, are we looking at a genuine durable demand recovery? Or is this just a temporary cycle high, masking the underlying cyclicality of the semiconductor market?
It's the multi-billion-dollar question, isn't it? Management obviously points to broad-based strength in data centers and secular growth in automotive chips. Cars need more chips today than ever before, right? But your skepticism is valid. Semiconductor cycles are historically vicious. However, TI's management isn't just sitting on this cash waiting for the cycle to turn against them. They are deploying it incredibly aggressively to build a wider economic moat.
Section 3. The Silicon Labs Blueprint. Let's evaluate this $231 per share all-cash buyout. Expected to close in the first half of 2027, this deal requires us to look at exactly what TI is buying for $7.5 billion. As we mentioned, this is a $231 per share all-cash transaction. They are taking out a major industry player to bolt right onto their existing architecture. On the bullish side, the concrete synergies are frankly incredible. TI management states this will be accretive to earnings per share in the very first full year post-close, excluding transaction costs. Strategically, this massively boosts TI's footprint in ultra-low power edge connectivity, the smart home, industrial Internet of Things, or IoT, and smart cities. These are huge growth vectors. They are buying a premium portfolio that plugs right into their massive global distribution network. And on the bearish side, I am aggressively pushing back on the execution risk here. You simply do not execute a $7.5 billion cash buyout without taking on a heavy, heavy debt load. Let's look at the balance sheet as of Q2. TI only had $3.66 billion in cash and cash equivalents and about $3.3 billion in short-term investments. They simply do not have the liquidity just sitting around in checking accounts to pay for this. They will absolutely need to issue debt. Add in the regulatory approvals required across multiple global jurisdictions over the next few years, and factor in a potentially volatile macroeconomic and memory chip supply environment by 2027, and its integration could hit major costly roadblocks. I hear the risks, but you have to look at the manufacturing blueprint to understand why they're doing this. TI's massive 300mm wafer manufacturing expansion strategy, heavily concentrated with their fabs in Texas and Utah, is their ultimate sustainable competitive advantage. Just for context, larger 300mm wafers yield significantly more individual chips per wafer than the older 200mm standards, drastically lowering the cost per chip. TI's explicit goal is to source more than 95% of their wafers internally by 2030, with 80% of those on these highly efficient 300mm lines. By plugging Silicon Labs' high-margin IoT designs directly into TI's expanding, low-cost, geopolitically dependable 300mm wafer capacity, they are creating a formidable competitive moat that is nearly impossible for smaller, fabless competitors to replicate. Okay, the 300mm moat is structurally strong, I will give you that. The manufacturing economics make sense. But here is the crack in the armor that retail investors care about most. Will the debt financing required for this $7.5 billion cash deal crack TI's legendary shareholder return policy? Texas Instruments has claimed for years that they are committed to returning 100% of free cash flow to shareholders over time. It's why people buy the stock. Yet, if we look at the trailing 12 months, stock repurchases absolutely plummeted by 61%, down to just $707 million. Overall, total cash return to shareholders fell 13% to $5.8 billion. So my question is, are they quietly abandoning their massive buybacks to hoard cash and service the impending debt for this acquisition?
That is the exact tension in the capital structure right now, and it's a critical observation. They did return $5.8 billion over the last year, which is still a massive absolute number, but the mix definitely shifted heavily away from share buybacks and toward the dividend. They did increase the dividend by 5% in 2024, maintaining their decades-long streak of dividend hikes, but the reality is that the debt load for Silicon Labs will absolutely require them to be much more disciplined with discretionary share purchases in the near term. The scaffolding is shifting.
Section 4, Q3 Construction Outlook. We're breaking down the guidance and capital allocation. Let's move the discussion to the forward-looking projections to gauge the structural strength of the coming quarter. Because past performance is great, but we need to focus on their guidance and how they plan to allocate capital while balancing this new massive acquisition target. The Q3 guidance they issued is undeniably bullish and shows continued momentum. Management is targeting revenue between $5.65 billion and $6.15 billion. The earnings per share target is set between $2.23 and $2.57. Now, it is worth noting they are projecting an effective tax rate of 13%. But overall, this guidance suggests they expect the broad-based demand strength across industrial and automotive to not only hold steady, but to actually accelerate into the back half of the year.
The guidance is sure. But remember what you just said. They are projecting a 13% effective tax rate. That low tax rate definitely helps that EPS target look a bit more polished and pristine than it might otherwise be. I'll concede that the top-line revenue target is a solid sequential step up, which is a good sign. But we still have to watch how their massive capital expenditures are going to weigh on the cash generation moving forward.
Speaking of cash generation, management wants investors to focus intensely on this metric right here, the long-term free cash flow per share trend line. If you look historically from 2004 all the way to 2022, they grew this at an incredibly steady 11% trend line. They are vigorously arguing that this long-term trend line remains fully intact as their currently elevated spending begins to modulate and taper off. In fact, TI is explicitly targeting over $8 of free cash flow per share as they come out on the other side of this massive investment cycle. Well, let's debate that capital expenditure, or CapEx, right now. They state they are nearly 70% through a 6-year elevated CapEx cycle to build out those 300mm fabs we talked about earlier. They project that CapEx will finally reduce to a much more manageable target of $2 billion to $3 billion by 2026. But the question is being 70% through an elevated cycle a dependable moat, or has this just been a massive capital drain during a period of intense cycle volatility? Furthermore, they are running what they call a flexible inventory strategy to prepare for the next upcycle. That basically means they're holding a lot of chips in warehouses, which ties up even more working capital today for a payout tomorrow.
It absolutely ties up capital in the short term, there's no denying that. But having finished goods inventory ready to ship the second the cycle violently turns upward, allows them to capture market share immediately, while their competitors are scrambling to secure foundry allocation just to get chips printed. It's a heavy upfront cost, but it's designed for absolute long-term market dominance.
Section 5, the iron verdict. Is this a high-yield fortress or a capital trap? We've inspected the foundation, we've reviewed the blueprints, and we have rigorously stress-tested the leverage. It's time for us to deliver our final, no-nonsense judgment on TXN's structural integrity. My verdict? Texas Instruments is an ironclad dividend fortress. The sudden 23% revenue growth to $5.5 billion, those massive 42% operating margins, and $6.5 billion in trailing free cash flow prove that the core model works beautifully. And the $7.5 billion Silicon Labs M&A strategy, it is brilliant. It plugs high-growth IoT and edge connectivity directly into their low-cost, domestically secure 300mm manufacturing mode. The trend line to $8+ in free cash flow per share is absolutely real, and they are building for the next decade. Market skeptic. I see the structural strength, but I am issuing a strict warning on the cracks in the foundation. The 61% drop in buybacks proves that the impending $7.5 billion acquisition debt is already restricting their legendary capital return policy. Between government CHIPS Act subsidies inflating cash flow to the tune of $1.6 billion and a massive capex cycle that still isn't fully finished, this could quickly become a capital-intensive trap if macro demand falters and that inventory doesn't move. So we leave it to you, the viewer. Are you buying the fortress, or are you waiting for the cycle to break the foundation? Let us know in the comments below. Make sure to hit subscribe so we can help you forge a stronger portfolio, and we'll see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.